The November jobs report is out, and here are the numbers. 203,000 jobs added for November. The unemployment rate ticked down to 7%. I have with me Chief Equity Strategist of S&P Capital IQ. You probably know him, Sam Stovall. Sam, thanks for being with us.
Good to be with you, Joe.
So, Sam, what'd you think of the top line number?
I thought it was good, but more with a lowercase g. Probably additional reasons why the markets, might feel slightly positive on this information. We've had 5 down days leading up to this, thinking probably we're going to get the worst. And actually, we got a number that was around what we got last month. And as we also heard, revisions for last month brought it down a little bit. So I would say we are seeing the metamorphosis from a stimulus-driven economy to a typical growth-oriented economy, but a very slow one.
Yeah, stimulus to growth. We'll return to that in a moment. Talk to some taper. As you just mentioned, October was downwardly revised to 200,000 from the 204,000. Labor participation rate actually rose to 63%. So we saw that unemployment rate at least go down from 7.3 to 7%. What do you make of that? I mean, that's what you want to see. Is you want to see that rise in participation.
I think you do. I think that these numbers are all good for a variety of reasons. It is indicating that the economy is improving. It does look as if it's likely to stand on its own 2 feet, but at the same time, it's not getting up too fast and therefore likely to faint later on. So the feeling is that, yes, the Fed will probably engage in tapering. The question still remains, will they do it in December? Standard & Poor's Economics believes that we will see it in December, at least slightly more than their expectations for the first quarter of next year, but at least we're not moving too quickly that will threaten us to go from tapering straight into tightening.
So moving away from the taper talk, I know a lot of people will just say, oh, come on, get off it, right? But you sound like you're pretty optimistic right now, at least in terms of some of the streaming data we've seen come in over the past few weeks.
Well, I think so, just to say that the trajectory is still upward. Yes, it's a low-flying economy that is definitely vulnerable to dangerous downdrafts, but I think we're slowly gaining altitude, and so as a result, I think that 2014 could end up being a good year, but not a great year.
So let's get to the bottom line here on stocks. Investors are going to look at this number today, and what do you say to them? Is it time to remain? Should you remain in stocks, and should you be a little bit bullish headed into 2014?
I think heading into 2014, you remain bullish. The trend is your friend until it ends. But I would advise investors be prepared for more volatility. We've gone 26 months without a decline of 10% or more. The average since World War II is 18 months. The median is 12 months. But I wouldn't say bail out because it takes us only 4 months to get back to break even from a decline of 10 to 20%.
All right. Well, Sam Stovall of S&P Capital IQ, great to have you in studio.
My pleasure.
For The Street, I'm Joe Deaux.